Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and higher taxes, no matter who wins in November, could be reality for Americans as the Tax Cuts and Jobs Act will unlikely be extended without modifications, regardless of who wins the national election in November. Joining me on the desk at the Nasdaq market site to discuss what stands to change and strategies for tax planning is James Sahagian, Managing Director at Ramapo Wealth Advisors, an affiliate of Steward Partners. We have Craig Ferrantino, President of Craig James Financial, and Jessica Perna, Partner at Partner Tax with EY. It is great to have everyone with us. Welcome to Trade Talks. Welcome to MarketSite. Let's go around the horn here first, James, starting with you, and just give us a brief overview of where you sit within the financial ecosystem.
Sure. James Sahagian, Managing Director and Certified Financial Planner with Ramapo Wealth Advisors. Been an advisor for 25 years, mostly working with the mass affluent, and 85–90% of my clientele are individual investors.
Right. And Craig?
I'm a certified financial fiduciary, certified wealth strategist. This is a big topic, so I'm excited to be part of it today. And president of Craig James Financial. My market is mostly mass affluent. First responders would be the best way, law enforcement, fire department, things like that.
All right, and of course we've had EY on the show frequently. Tell us what you do, where you fit within the ecosystem.
Thanks, Jill. Jessica Perna, tax partner in our private client services group within our financial services office. So dealing with ultra high net worth and high net worth individuals, specifically in the private equity and hedge fund space.
Right, and let's talk about what the TCJA is, Craig. You know, we typically focus on what's happening with fiscal policy on the show here at Trade Talks, but I think this is going to be something that will be in the vernacular heading into the election.
Yeah, $34 trillion in national debt and over $1.5 trillion in annual debt for the decade ahead and growing. It's highly likely that the Tax Cuts and Jobs Act is going to take center stage as the election approaches. And it's more than likely, as you mentioned, that regardless of who wins in November, we'll likely see major modifications to the TCJA after it expires in 2025.
So, Craig, what stands to change?
Oh, there's a lot. I mean, there's a lot on the plate. You're talking about the state and local tax, which is a sticking point, particularly in our New York area and New Jersey as well. They want to, there's a whole delegation of even Republicans that want to remove that because it's hurting their constituents. You're going to see the child tax credit. You're going to see the middle. If it goes back to the old rates, you're going to see the 22% rate go to 24. I just want to throw out numbers. The 24% now goes back to 28, and the highest on the high end is the 35 goes to 39.6. And of course, there's a topper on that to pay for Medicaid from the Obama.
Jessica, do you think that there could be an extension or another version as we know the TCJA today, or do you think TCJA today, or do you think this is going to be a massive overhaul?
So, just taking a step back, any extender of TCJA is going to cost trillions of dollars, right? So we're likely to see careful consideration on whether we're going to extend entirely, modify, or just scrap and start new. Right? So I think that's the conversation is even if everybody agrees, the big question is how is it going to get paid for? So I think we're likely to see something change, some modifications here or there, but then discussions talking about, well, how can we pay for it and what else can we do to get those funds to extend certain parts of it?
Well, it almost sounds like an extension is what's going to have to happen. I feel like we have a hard time legislating virtually everything, and this is one of the biggest talking points when you think about what Republicans and what Democrats want, for better or for worse. So it almost seems as if an extension is the most likely scenario.
I don't think it's the most likely scenario. Actually, I think it's more of a modification or nothing gets done at all. Because remember, we need action to extend, right? It'll sunset automatically if nothing gets done.
Okay, so Craig, how will this impact Americans, the average taxpayer?
Oh, it's going to certainly hurt the mass affluent, which is the middle class. They're going to see their numbers go up quite a bit. I'm going to take issue a little bit with Jessica's point. She's saying, there's two parts of a government. There's revenues. We've taken in the most revenues in our history under the Tax Cuts and Jobs Act, and then there's also expenses. And I think the problem is, in your bleak outlook, I think there's no discussion of expenses on the government side. We're starting to get some cuts now. We'll see what happens in the future, but I still think that you can't just keep raising every year when you have interest rates, which is costing the U.S. government that $1 trillion is going to add another trillion every 100 days to the debt. So that's huge, and that's going to, you just look at the projections by the CBO for 2028, you're going to see what the debt's going to be in the high 40s. So they really need to start to look at expenses as well.
Especially they have to service that debt.
That's right. At a higher interest rate, it's costing them a lot more money.
Right. Well,
It's actually exceeding the defense budget for this year.
Yeah, I mean, that's a number that's hard to wrap your head around, but particularly in New York and New Jersey area of which you guys service. I mean, look at salt. That took away a lot of deductions for us. I mean, thinking about it now as we're doing our taxes, which are due shortly, but it seems as if the middle to upper middle class within this area is just getting hammered.
Yeah, well, then again, you brought up the salt. It didn't affect the people who have houses in Levittown, because their taxes are $10,000, $11,000, so they had a $10,000 deduction. But it is affecting the people who live in the very nice houses where they're getting, their taxes are, I don't know, $35,000, $40,000, and they're only getting a $10,000 deduction, so they're paying more in federal taxes.
Well, by us in northern New Jersey, a very modest house could very easily have state and local taxes well over $10,000. And if you think about the world we're living in today, it's completely different than when this Tax Cuts and Jobs Act passed in 2016, implemented in 2017. Pre-COVID, the debt was virtually half of what it is today. And we were on a trajectory when it passed of under $400 billion in annual deficits. We're currently running over $1.5 trillion in annual deficits and rising. So completely different world. I agree with Jessica that it is very likely that Congress will move to let certain parts of the TCJA expire, thereby not taking ownership of the tax hike and just letting it take its natural course. So I do expect that.
So what happens if it expires? I mean,
So
how do we know how to pay our taxes?
So that, one of the things is knowing the provisions that are going to expire and being prepared and doing something now in order going forward to take advantage of that. So Craig had indicated that the ordinary rate is going to go up from 37% to 39.6%. So just keep in mind that's wages, interest, short-term capital gains. So what can you do now? For example, accelerate income at these lower historical rates. So that's something that you would say, if it's likely those rates are going to go up, then how do I bring income into my tax periods now in order to benefit from that and not bring it in later? Right. So an example of that could be converting your traditional IRA or former 401k to a Roth IRA. And what that happens is you take existing money, you roll it over into a Roth IRA, you pay the tax now at the ordinary rate, which is 37% at the highest marginal bracket. Take the tax now, and that grows tax-free in retirement when the rate could be higher.
Yeah.
Right.
We often advise our clients, especially our younger clients in their 20s, 30s, and 40s. We often use the analogy of paying taxes on the seed versus taxes on the harvest. And if they're in a younger age group, they might have 30, 40, or even 50 plus years of tax-free growth of that money. A very powerful financial planning tool.
Well, the obvious question is, I probably should have asked this at the top, when do these expire? Is at the end of December 31st?
Yes.
2025, yeah.
Right. Okay, so you have...
We're in the lowest tax rates in our lifetimes, in all of our lifetimes. I think it's a fair statement.
Unlikely to stay there.
And well, it depends on how things go going forward. It is the way, either you spend your way out of a problem or you create growth in the economy. And clearly, the best way to grow the economy is to keep the tax rates low and grow the economy. Spending is not helping because it just gives people more money, and goods go up because there's a lot of dollars chasing the same goods. And so we need to do something a little different. And I think it's where the cuts, and that you're talking about New Jersey, New York, we're the highest tax states in the country, but you don't hear, I think they cut the city education budget 5%, and I don't know if that's going to last the whole year. They can't, it's just hard, they can't cut. And somewhere along the line, someone's got to be the grown-up in the room and say, we can't just keep having things going up, and that's my opinion.
Whether
that happens or not is a different story.
Many of the provisions are automatically set to revert. So currently, the exclusion for estate and gift taxes is over $27.2 million for a married couple, $13.61 million for an individual. And if nothing is done, that will get halved in 2026.
A lifetime exemption, yeah.
Right, especially if you're working with ultra high net worth individuals, it's not inconceivable that they do have multiple millions to pass on. You know, it's generational wealth that you're thinking about.
Sure.
So the plan is, if you think you're going to have a significant estate where when it reverts back to half and you're above that, you should gift now and act now, because there's not going to be a clawback. If you go over, if it gets cut back and you gifted more than that, the IRS isn't going to come and say, hey, you pay tax on that now. So you can gift it now. It's under that lifetime exemption. It gets cut back, but you already gave it away. And not just that, the appreciation that goes along with it. So these are all things that we're looking at to do prior to the expiration.
So are you working with clients now to structure their
Absolutely.
estate plan?
We're having active conversations. As Jessica mentioned, Roth conversions are a big deal, gifting strategies, funding 529 plans for children, grandchildren, others where those monies could grow tax-free and they're out of the person's estate. These are all tactics. Bundling charitable contributions, where you could use a donor-advised fund to make substantial contributions. 87% of Americans are currently taking the standard deduction, so they're not taking advantage of the itemized deductions that you could get with charitable contributions. But by bundling them and using a donor-advised fund, these are ways for people to take advantage of that itemized deduction on charitable giving.
Yeah, it sounds like it's pretty complicated. I mean, certainly you need an advisor, I'm sure a team to,
You really want to take a look at that. Donor advised funds could be a little funky too, so you got to be careful. There's also QLACs, which are people, I've seen some of the research, qualified life annuity contracts, which allow you to move the estates well into like age 85. So it's another technique. But irrespective, you got to do it now. We have 657 days, Jill, before this happens. And so I'm grabbing people literally by their shirt collar and say, look, we got to get this done. We got to get this done. We got to get you less tax toxic for the future. And that's critical. If you're not doing that, if advisors aren't doing that, it's very tough. And I go into a group of advisors and I'll tell them the same story and they look at me funny. And I'm like, no, this is what we really need to do. It's not about how much money you make, it's how much you actually keep. And if you're not structured properly, you're going to be taxed a hell of a lot more than you thought.
Yeah. I wonder if people living longer, if that impacts the strategy as well. I guess they're spending more if you're living longer.
Sure. It's, I think going into every calculation of government, when I started in this business 25 years ago as a financial advisor, I think the full retirement age was 62. And now for me and many of us is 67, going up to 70. So I think, that's all part of the calculation as well. And is definitely need to factor into people's financial
Will it impact Social Security or benefits that are received from the government, the new tax structure?
Look, there's a lot of things we don't know, but I'm pretty sure that they will modify the Social Security terms yet again, and most likely by pushing the full retirement age back for, especially for
Trump came out with something just recently, which just came out of the blue, but he said every 6 years they're going to increase it by 1 year. So it'll take a long time. Won't affect anybody now, but let's say the minimum age is 62, it'll go to 63. And by the way, that's a way to reduce some of the expenses we're talking about. That's just one idea, aside from cutting different departments and things like that within the federal government.
Yeah, I mean, certainly people have the capacity to work longer. We see that in the workforce now. So, what other ways are you advising clients? Is this specific to only ultra high net worth individuals, or does it run the gamut of all taxpayers?
No, it runs the gamut of all taxpayers. So, the gifting lifetime exemption, that's a very unique set of facts with certain individuals who can give that much money away in their lifetime, right? But the Roth conversion is for anybody. You can convert your traditional IRA to a Roth IRA, and that's a way to save for retirement. Again, taking advantage of tax advantageous accounts like 529 plans. You don't get a federal deduction, but it grows tax-free and you're not taxed on that money when you take it out for education expenses. Additionally, we see a lot of people like pre-funding 529 plans where you're giving 5 years worth in year one to get a benefit of that compounding, and there's no gift tax consequence. Another maybe specific strategy is incentive stock options, and what that is they're called ISOs, and it has an alternative minimum tax ramifications. So you can, right now, under the TCJA, those phase outs are much higher. So you can actually exercise your ISOs for alternative minimum tax now, pay less tax, and then later on, if you didn't do that, you'd be in the alternative minimum tax. So that's a strategy very specific to a certain type of people. So there's many things you could do. So I would encourage everybody to talk to their tax advisor if they want to take advantage of anything before these sunsets happen.
Can we just have a flat tax? This seems so complicated.
Or a VAT, right?
Right,
Yeah.
right.
Value-added.
Yeah.
Careful
back
what you
Steve
wish for, it may
Forbes.
come.
Right. Well, I mean, it almost sounds like double dipping. I mean, the wealth that you've created, what your heirs will inherit, it's already been taxed, right? So then they're going to tax it again. I mean,
Well, you saw that change in the IRAs that you had. Now we have to take the money out if you inherit an IRA in 10 years, because this is money that's never been taxed. People deferred money from their payroll for years, and when the child or whoever inherits the account, they have to clear it out in 10 years now, and that's caused some. As a matter of fact, there was some misaccounting issues in the first year or two of that rollout. So the government's looking for that money. But again, they've raised more money than they ever have in history the last 2 years, even with COVID.
Traditionally, most people in higher tax brackets did not gravitate towards Roth conversions because they didn't want to pay the very substantial taxes that are owed at the time of conversion. But I think given the environment we're in right now, even people in the highest tax brackets, especially those in their 30s and 40s, I think it does make sense to take a look at taking advantage of the, the conversion opportunity right now.
Yes.
right. And before, I was kind of being flippant about it, but why not a flat tax? It makes it, I mean, if I understand it correctly, the American tax system is the most complex globally.
Absolutely.
Is there a downside to a flat tax?
So, I mean, there's pros and cons to both. I think right now this is a very complicated system and structure, and so you have to be very savvy and nimble to be able to prepare your tax return. And if you are ultra high net worth, there's a lot of complications in planning that go into it. So like, for example, your Roth conversion example on how ultra high net worth individuals may not necessarily have wanted to do it, but then they come to me and I'm like, well, pair it with a really big charitable deduction. So, you are incurring income, but we're pairing it with a deduction that they were going to do anyway, and essentially making that net to zero. So it's complicated, and there's ideas around it, but that's the part of my job.
Yeah, it sounds like you're playing chess all day long, really.
Well, there's a lot to think about, and the rules keep changing, and I'm sure they're going to change quite a bit more between now and the expiration.
You got to realize there was a salary cap on when you could do a Roth IRA. So so if you made over $150,000, you couldn't do a conversion. So they removed that so that anybody, Warren Buffett, if he wants to do a conversion, could do a conversion.
There are quite a few billionaires out there with all of their assets in the Roth IRA, growing completely tax-free with no required minimum distributions. So, some of the most financially sophisticated individuals out there are taking advantage of the rules.
Absolutely.
All right. Well, appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.